Welcome to IFRS Meaning. Today, we will do a practical example of a business combination.
In the following video, we will make an example of a business combination. But before, it is important to understand what is a business combination. So, a business combination is a union of two or more entities into a single reporting entity. For example, Company A is an entity that is dedicated to the production of vehicles. But this company is interested in the intelligent development of this type of assets. For this reason, this entity acquired the Company B. On the other hand, the entity B is dedicated to software development. In this case, Entity A must recognize Company B's identifiable assets and liabilities, as we will see in the following example. We recommend you review other videos on our channel to expand the concept of a business combination. For now, let's focus on this practical example. In December of year 1, Company A acquired 90% of the interest of Entity B for $37,000. Entity B's financial statements are shown below. So, as we can see, Entity B has a series of assets and liabilities at cost and at fair value in its financial statements. Also, within the financial statements of Entity B, a client list was not recognized as it was generated internally, under paragraph 63 of IAS 38. This intangible has a fair value of $9,000. In addition, Entity B disclosed a contingent liability for a civil lawsuit in its notes to the financial statements. The fair value of this liability amounts to $14,000. On the other hand, the financial statement of the Company A is as follows. As can be seen, within Company A, financial statements, there is a recognized investment of $37,000, which is equivalent to the amount of the consideration paid for 90% of the shares of Entity B. Based on the above information, we are going to determine the identifiable assets and liabilities, the generated goodwill, and the non-controlling interest. To solve this exercise, we will first determine the identifiable assets and liabilities. IFRS 3 establishes that when a business combination is carried out, identifiable assets and liabilities must be recognized at fair value. As we can see in the example, there is a list of clients, which Entity B did not recognize because it was generated internally. However, according to paragraph 13 of IFRS 3, intangibles recognized in a business combination must comply with the principles of identifiability, be non-monetary, and without physical appearance. An asset is identifiable when it can be sold, exploited, or is capable of being separated or divided from the entity and sold, transferred, exploited, leased or exchanged, either individually together with a contract, an asset, or a related liability. This means that expenditures related to an internally generated intangible asset must be recognized in profit and loss. This taking into account that it is impossible to separate between the disbursements to generate this asset and the disbursements to operate the business. For this reason, IAS 38 establishes that these expenditures are recognized in profit or loss, and not as part of an asset. However, when a business combination is carried out, internally generated intangible assets behave as an asset acquired separately. For this reason, these assets must be recognized by the acquirer entity. Thus, the identifiable assets and liabilities are the following. Property, plant and equipment for $29,000. Licenses for $22,000. Client list for $9,000. In this way the total assets equals to $60,000. Besides, we have a financial obligation for $18,000 and contingent liabilities for $14,000. The total liabilities equal to $32,000. In summary, we have a net identifiable assets and liabilities of $28,000. The next step is the calculation of the non-controlling interest. This is equivalent to 10% of net identifiable assets and liabilities of Entity B. This interest represents the percentage of entity B which company A does not control. Now we are going to calculate the goodwill generated in the business combination. For this, it's necessary to use the following formula. Goodwill equals consideration paid, plus non-controlling interest, minus the net identifiable assets and liabilities. So, the goodwill equals 37,000, plus 2,800, minus 28,000. The result of this operation is a goodwill for 11,800. Company A must make the following accounting entries in its consolidated financial statements. An adjustment to property, plant and equipment for 6,000 and licenses for 3,000. This adjustment represents the difference between these assets recognized at cost and their fair value. On the other hand, we must also recognize the list of client and the contingent liability that the entity B had not recognized in its financial statements. The customer list for being generated internally, and the contingent liability because it is not a real liability. However, as we said before, it is necessary to recognize these elements in a business combination. On the other hand, it is necessary to recognize the non-controlling interest for 10% and the goodwill. And finally, we must eliminate entity B's equity and the investment initially recognized by entity A. So, we have the following information when consolidating the financial statements of entities A and B into a single reporting entity. Banks for 25,000. Property, plant and equipment for 51,000. This balance is the result of taking the carrying amount of 22,000 from entity A, the carrying amount of 23,000 from entity B, plus the adjustment for the difference between the carrying amount and the fair value of this asset. We carry out the same procedure with the licenses. Inventories do not present changes. The investment balance is zero because we must recognize this asset. And we also recognize the goodwill, the client list, and the contingent liability. Financial obligations do not present changes. Finally, we recognize the non-controlling interest for 2,800. And in terms of group equity, we have a balance of 71,000 because we derecognized the equity of entity B. In this way, we have the consolidated financial statements of the two companies after the business combination process. I hope this example has been useful. I'll wait for you in the next video. Finally, if you want to learn IFRS, be an expert and make a difference, we remind you to review our course on International Financial Reporting Standards. The course has more than 270 explanatory videos, more than 370 analysis questions, personalized advice, and real-world examples and cases. In the video description, you can find all the course information. Cheer up, and take your professional career to the next level.